For most Kenyans, access to affordable loans remains a major challenge, with banks currently offering loans at an interest rate of above 16% and as high as 20%. But now the government is looking to directly influence interest rates downwards, firstly by cutting back on its domestic borrowing levels.
By accessing these external funds, we will reduce government borrowing from the domestic markets, thereby helping drive down interest rates.
The government will review downwards the domestic borrowing plans for the next financial year. This will significantly reduce domestic interest rates, which should boost investment, economic growth, and employment opportunities.
However, the main intervention that the government intends to utilize is a new interest rate setting formula. Under the formula, banks will set their interest rates based on a 6-month average of the central bank rate and the 91-day treasury bill, a move that is expected to result in uniform interest rates across the banking sector. Banks will, however, be allowed to mark up on the interest rate.
All banks will use a reference rate to be determined periodically by the Central Bank of Kenya as the basis for pricing credit. The components of the premium above the reference rate will have to be disclosed to borrowers by the banks.
If you are a very good credit-worthy person, you may enjoy less margin, maybe 1, so it could be reference rate +1 or +3 if you are very risky.
The introduction of the new formula marks yet another bold attempt by the government to lower interest rates on credit. Analysts will now be keen to see how the government will, in coming days and months, also tackle interest rates on long-term loans, such as mortgages, which currently remain out of the reach of many. For the Citizen Business Center, I'm Henry Gedaiga.